where our focus on is companies where they have growth and also pay a lower dividend yield, but the dividends grow. Now, why don't I choose the one where there's high growth but no dividends?
Do you buy insurance?
I used to believe in it. At the end of the day, investing, again, is not just about your financial data, hard numbers. It's about understanding consumer behavior. It's about understanding why is it that certain people buy certain stuff. Why is it that people keep going to buy the same products and or services over and over again?
I was actually looking through like some of your background. Very interestingly, is like you major in materials engineering.
Yeah.
Yeah, and then actually last night I realized that I chanced upon your blog before. I mean, like some of your articles, and then before this chat, I was like looking at your latest one. You started like sort of like a mini portfolio. You have a main portfolio, then you started a mini portfolio.
Correct.
And you are trying to share with your audience like your journey or to build the dividend.
Correct.
Yeah. So maybe just to share a bit of context, last time when I started real estate, I actually like read a little bit about like dividend investing when I was a prison officer. So that was like 17 years back. Yeah, but I realized there was a key issue is that I didn't have capital. Yeah, so the dividend is like really tiny. Yeah, so that was my main problem back then. Then once I did real estate for about 4 to 5 years, I chanced upon this client that I was helping him to invest in landed. So what shocked me was that he told me that he said, hey Melvin, actually, because I was just chatting, we bought the landed already. Then I was asking like, okay, how did he build his portfolio? So he shared with me that, he said, Melvin, actually, this landed that I bought through you, I already calculated everything before I buy. All the installment will be paid by my dividend.
Yeah.
Yeah. So he actually built his dividend portfolio first, while he was living in a condo, which I helped him to dispose and then moved it into a landed. But his strategy was to use that annual dividend divided by 12 months, and that is like just nice to pay for the monthly installment. So it's like technically using
free. It's like almost free financing in this case.
Yeah. So it was like such an amazing strategy, right? Because we always believe in that. There's no one correct way of doing things. There's always like a complementary way to build like a very concise and balanced portfolio, because real estate is a very illiquid kind of investment.
Sure.
You lump in a lot of capital. There's also management and maintenance, property tax and stuff like that. So it's more illiquid because when you're like exit, it's unlike shares and stocks that you can just exit the next day.
Yep.
Yeah, right. So you can cash out certain portion and stuff like that. Yeah, maybe share with us a little bit on your journey back then. Like, why is it that from materials engineering you will go into like finance, and then after that now, because you went into like corporate finance, right, for a while. Then after that, now you start your own business, Dividend Titan. Maybe share with us a little bit.
Sure. Back then, right, materials engineering, I wasn't really very ambitious. I didn't really know what to do. And my mom, she was just telling me, hey, Willie, why don't you just get an engineering degree? Because it's a professional degree. And back then, it was one of the stable iron rice bowl to a career job. All right. Back then it was, okay, if you don't know what to do, just get an engineering degree and that's it. You are sort of set for life. So I listened to her. I sort of enrolled into materials engineering because to me, I thought that was one of the easiest engineering subjects to take. So I got in there and I realized that I hated it. Hated it because there was just so much content. There was so much mathematical calculation, and it's not simple calculations, but it was like very deep calculations, which I could never understand whether this would be practical in real life. Yeah, exactly. So because of that, I was almost kicked out of school. I still remembered that my grade point average was really close to 2, and if you drop below 2 for the second time, the dean or the school will actually send you a letter and say that, hey, you cannot continue to study. And
which uni was that in?
So that was in NTU.
Okay.
NTU uses a grade point average or GPA of 5.0, and if you are about 2, back then it was about 2 plus. There was one semester I sort of dropped below 2, and then it was pretty scary for me. And it really made me think, hey, do I want to actually go into engineering? That was one of the key things which got me to think about what I want to do, for not say the rest of my life, but hey, is this really what I want to study for the next couple of years? So that was one of the key thinking first. Another one was just nice when we talk about finance, right? Why did I move from engineering to finance? It was really one of the sessions where I got back from, it was a dinner, and I still remembered one of the conversations which we had. And my mom was saying, hey, really, you need to start to cut back on your spending and your expenses. And that was pretty scary because she opened up that one-liner and I didn't know what was going on. And I realized that, my dad's company, he was working for a small company in a creative agency. And back then, during the global financial crisis, it wasn't really doing very well. Because of that, the salary got cut. And, as a result, my mom had to sort of advise us to sort of tighten our budget. So that actually put into my mind, hey, I need to make more money. And it really got me thinking about how to make money somewhere.
Were you still studying back then?
Yeah, so I was still studying.
At NTU?
Correct.
Okay,
yeah,
so like second, third year.
Yeah, so these two ideas sort of somehow connected or gelled together. And it was only upon I chanced this idea about making money. Back then you are so attracted in making sort of what I call passive income. You want to make money on the side. And I was looking around. So I was also giving tuition. I was doing part-time. And I came across the idea of, stock markets, trading and all that. So that's where I started to read, and that's how I eventually got my journey started out from engineering to finance and investing here.
Did you get a chance to work as an engineer after you graduated?
No. So right from the start, how I moved was as an engineer. I actually continued to study engineering, but I was actually very determined to get into finance. I saw like, hey, this is something which I really enjoyed because number one, it was very intellectually stimulating. Like I like the idea of how businesses work, and I like the idea of how, hey, actually you can do something on the side, because when you invest, right, you don't really have to go out there and exchange time for money. Back then, I was doing a lot of part-time jobs. I was working as a Cat 6e technician. I was doing admin stuff at one of the transport companies in Singapore. I was giving tuition as well. And because of that, I felt that I was constantly out on the road and, just making money, but I was always outside there. And I was thinking, is there any way where I don't have to exchange my time for doing all this? So that's how investing really came about. And it was pretty interesting because I started to read about trading. I started to read about technical analysis, but it was only by chance where I chanced upon a book called The Intelligent Investor, and that also happened to be my second year roommate. He introduced me this book called The Intelligent Investor. It was a book written by Warren Buffett's mentor, Benjamin Graham, and he spoke about how stocks should be treated like businesses and not pieces of paper. And that really opened my mind, because I always thought that, hey, trading, isn't it about all these shares and all that? I would never think about them being businesses itself. And that really opened up my mind about finance, about investing. Because at the same time, while I didn't really enjoy engineering, but what I really enjoyed was the sort of the intellectual challenge about understanding businesses, how they make money, and how can I actually make use of what I have, knowledge capital, which is sort of the buzzword these days, how you can actually make use of knowledge to make money here on sort of the side or passively.
Right. So while studying, and then you had this realization, and then you start reading up. Right. And then once you graduated, what happened?
Okay, so maybe I'll just take one or two steps back. So for engineering, around year 2 or year 3, I decided, okay, this is something which I want to do. And I decided to take on the CFA program. So this is one of the, according to finance, is one of the gold standards in finance. If you want to get a job in investment, in an investment career. So that's where I started to put in all my time and effort into going into studying about investing. I tried my best to get into a finance related institution. So I wanted to be a securities analyst. That means someone who researches stocks, someone who analyzes stocks. So a lot like what Warren Buffett does, a lot like what his mentor, Benjamin Graham does as well. And this is something which I want to actually go in. The interesting thing is that when I applied, I got rejected. Like I got rejected by most of the investment management company. And the reason was because it's either they see that I don't have any experience. They say, hey, you don't have any experience on your resume. While a lot of my business peers, my finance peers, they had internship with the big banks, the investment banks. But for me, because I was an engineering graduate, I didn't have a top tier class. I didn't have a strong honors. So it was very difficult for employers to want to take me.
But you have the cert already. The CFA.
So the CFA was only the first level. You have to complete 3 levels. But even then, they still look at your bachelor's degree. And the problem was that I didn't have that kind of pristine first class degree. I didn't have that kind of pristine degree which a lot of my other friends have, because that time I was staying in a hall, and then a lot of them, business finance students, they will tell you, I interned at Goldman Sachs. I was at Hong Kong, in Barclays. I had none of those. So when I went to career fairs, I passed my resume. I still remembered one time I passed my resume to one of the local insurers in Singapore, because insurance, they do have an investment operation. And they look at my resume and they looked at me and they say, I'm sorry, you don't have the experience. You don't have the honors. It's very difficult for us to actually help you apply for this role. And it came as a shock, because to me, back then I was in my 3rd or 4th year already. And for career fairs, they only open up to sort of your penultimate or your last year students. I didn't know what to do, because number one, I didn't know where to get the experience and I couldn't apply. But I really motivated. I was driven to, I only want to do this. So it was a big challenge for me. So I remember I went onto the website, they call it Investment Management Association of Singapore. And I sent all the resumes to each and every of the investment companies in Singapore. Either it was radio silence, or they rejected me, or it just went into the spam mail or the junk mail. So it was very tough for me to actually apply as an engineering graduate. So what I did was, I took out the CFA and I started to sort of double down or go all in on reading about finance and investing. So I tried to self-teach myself. So I watched, so there wasn't any YouTube, but I was reading up books in the library. I was trying to talk to friends in finance. I pivoted a lot of my elective modules in school to finance-related topics. So like business finance, marketing.
That was your 4th year?
That was my 3rd and 4th year.
Right.
So from the 2nd year, I decided to make that decision. The 3rd and 4th year, I decided, all my elective modules, as and when I can, I go into business-related modules. And because I wanted to absorb as much as possible. So I even took up like a class in entrepreneurship just to understand how business works. I want to understand what are, terms like present value, what are economic terms, what is microeconomics, what is macroeconomics. So I took up economic classes as well, even though I had C's or B's for those modules, but I didn't really bother, because I wanted to understand how things work, how people use certain lingos, how people use certain terms. And at the same time, while I was studying those modules, I also read up about investing myself. So I read up as many investing books as possible. I tried to understand and learn about famous investors. So Warren Buffett is one of them. I also learned about other famous investors like Seth Klarman, Howard Marks, Peter Lynch, Joel Greenblatt. So people, investors who have different strategies and have made their mark in the whole investment world. So just trying to absorb as much as possible. And then, of course, trying to spend some time to also practice reading about financial statements, about annual reports.
Right.
Because I emulated what some of these investors were doing, and I tried to actually do it on myself. So when Warren Buffett says that, I read like hundreds of pages of annual reports every single day,
I
say, I'll just do it.
Him.
Yes, exactly. So I'll just do the same thing as him. And then when some of these investors, they say, I go out and meet new people. I talk to people to understand about businesses. For example, like Peter Lynch, he goes down to shopping malls. He will bring his family. So Peter Lynch is one of the famous investors who manages the Fidelity Fund years back. He made his mark investing in businesses, and he would bring his family down to shopping malls in the weekends, and he would try to observe what his wife was buying. And that was what I did. So I would go down with my girlfriend, back then girlfriend, and I'll try to understand what she shops, what she buys, and I'll try to see what brands she likes.
And why is she doing that?
Yes, correct. And then I'll try to figure out, is this brand, does this brand belong to a listed company? does this brand belong to a certain company which I can actually find on the stock exchange? And then I'll try to peel out the annual report and try to understand, try to read, okay, what's this company doing? Are they making money?
What's the strategy and all that?
So I was trying to do as much as all this, hopefully to gain what you call your street cred or your resume in finance and investing. Hopefully, getting into that first footstep or the first door into finance itself.
So all this were happening in your uni years?
Yes. Back then I think it started somewhere around 2009 where I got started interested in reading about investing. And then 2010, bought my first stock. And then I was more motivated to understand what investing is, how to trade your stocks, what are some of the different strategies as well, and then also determined to get into the industry.
Right. So did all this like prep work and then like, because based on what you're sharing is that all these are really because of the fact that you wanted to do real learning, right? So it's like you really wanted to learn. So did all this resulted in you landing a finance job?
Eventually, I managed to get into an investment bank for a start.
After you graduated?
After I graduated, but it wasn't immediate. So it was through months of rejection. And then just so happened where I told myself, okay, I wanted to sort of give up and just apply a sales engineer role, because I was thinking I'm not going to be a research engineer. Maybe I'll do something where I can, meet people. So I thought of, okay, just applying for a sales engineering role. And back then it was going through like the e-career portals and all that. And back then you had Recruit Express, and I was about to give up. There was this particular recruiter who came, I can still remember, my friend asking me, hey, Willie, why don't we just go down to an agency and then just give this recruiter or recruitment agency a try? So we went down, and just so happened on the spot itself, the recruiter asked, hey, we actually have a research position for you. And I was quite happy. In fact, I was very surprised and elated, because usually research roles, they don't really come in the form of contract roles. But just so happened that particular incident happened. So I applied and I thought I would get it, but I didn't for a while. So we sat through the interview. After months, we didn't really hear from them. It's only after I called them and say, oh, actually you got selected for it. And, I was quite happy. So the reason why was because I was initially rejected because they had someone else in mind already, but that person couldn't come to Singapore to work because the visa wasn't approved or something. And then that puts me down into the second choice, which was me. And, that's where I got started into finance.
So was that a bank or?
Yep. So I was working back then it was Deutsche Bank, and I was doing macroeconomic research. So I was helping an economist to do her forecast, her country research, and all that. So that was my first step into the whole realm of finance.
Okay. How many years were you there?
So I was there for about a year plus, and I realized that I wanted to do more investment focused work. So that was more of macroeconomic research, trying to understand about countries, about what, for example, what balance of payment is, how does the currency impact, interest rates, and how interest rates affect like your inflation and the country's GDP. So that was something which I liked, but it wasn't really what I really enjoyed. What I truly enjoyed was still investing and understanding companies and businesses. So that's where I moved from Deutsche Bank to a boutique investment fund in Singapore. And that really got me kick-started in the whole realm of investment research, finance and investing. So I started off my career as a fixed income analyst, researching on bonds. So it's not the typical government bonds, but you're talking about corporate bonds, companies where they want to issue money or raise money. And some of these companies might not be very high quality companies. That's why your interest, your yield, your interest coupons, your interest rate could actually be much higher. And that's where things start to get pretty exciting, not just for investor, but for an analyst.
How long were you there at that fund company? So
roughly about 2 years plus.
Okay.
That's where I started to understand more about what investments were, how an investment fund is. It sort of convinced me that, hey, this is what I want to do. looking at companies, looking at businesses, trying to analyze what bonds are, trying to understand what stocks are as well. So it really opened up my eyes into this whole world of investing.
Okay. And then after that, was that how Dividend Titan was formed?
So my corporate career lasted about 6 years plus.
Okay. So I went somewhere else as well.
So I moved from investment fund. I moved to private bank. So I worked in private banking. I was a fixed income analyst there. About 6 years plus into my career, I realized that, I was kind of burnt out. Back then, somewhere in 2014, 2015, there was the oil and gas, the oil price crash. So a lot of the offshore marine companies, they actually gone into default. And back then I was dealing with all the restructuring because private banking, there were a lot of, rich, wealthy clients who invested in a lot of these high yielding bonds, but they weren't fundamentally strong. And that resulted them into losing a lot of money. I spent a lot of time helping out with the restructuring, reading through prospectuses, and that sort of got me thinking, okay, is this really what I want to do in corporate? So a little bit of what I truly felt back then was that I felt that I wasn't really cut out for corporate culture. I didn't really like the kind of rigid setup. I didn't really like the kind of bureaucratic setup. And to me, for politics is a big no-no for me. And that's how I, after I sort of saved and invest for a couple of years while I was in banking as well, I decided, okay, this is something where I want to do something on my own. And that's where I quit somewhere in 2018. And I started to say, okay, maybe I want to start investing for myself, for my family, and also launched DividendTitan.com.
Right. So Dividend Titan was launched in 2018.
Dividend Titan was launched in 2020, but I took a
sabbatical,
a short break about close to a year, trying to figure out, okay, what is it that I really, really want? Because after 6 years into the career, sometimes you sort of get tired from all the things which are doing day in, day out.
Right.
And I don't know, sometimes I also ask myself, hey, is this something which I want to continue doing? So I did a bit of what you call, it's a bit, it sounds a bit cringy, but I did a bit of soul searching. And I tried different things outside of finance, trying to discover, okay, what is it that I really, really like? What is it that I don't like? What is it about banking which I enjoy? And what is it about banking which I didn't like? So I realized that in banking, what I really enjoy is my colleagues. People to share ideas. If you're speaking with an analyst, we exchange ideas, data points. If I'm speaking to a client, I enjoy sharing the insights and ideas which I've researched. What's good to, what's the latest potential ideas. That's something which I really like. What I didn't enjoy was the whole bureaucracy, the whole politics and the rigidity of the whole banking culture. So it can get very stressful, very pressurizing, especially when you have a lot of the bankers which are driven by performance, right? You want to always be at the top of the, what you call the league table, making the most money. And that sometimes might not have a strong alignment with investing. Because sometimes investing, it's also about, buying something and then you are holding up for the long term. But in finance, on Wall Street, it's all about how much transactions, how much trades can I do to make that kind of transactions.
It's a volume game.
Exactly. So there was that misalignment in the industry itself, which I didn't really quite enjoy.
Right.
So that took me a while for that, about a year plus. And then somewhere around 2019, 2020, COVID hit. We are all stuck at home. And I was thinking, okay, I have never written a blog, and it's something which I've always wanted to do. I've actually written a blog with 2 other friends years back. And I thought, why not write something for myself? And why not create something for myself? And since we're all stuck at home, the only way I can do something is to go online and create something. So that's how the idea of a blog came about. And back then I was already investing for dividends. So then I was thinking, okay, why not just talk about dividends, which is something which is very recent, something which is fresh, still fresh in my mind. And it's a bit different from what I was, learning or what I was doing in corporate. Because back in corporate, I was doing a lot of fixed income. I was doing a lot of high yield bonds. So it really came back home to talking about stocks, which was my really first love and my passion for investing.
Right. So it's been about, is it about 6 years already? Dividend Titan.
Yes, so I think it's about, so Dividend Titan
2018 to 2024 now, 6.
About 4 years,
Right.
2020. I started writing in 2020 during COVID.
Okay.
So it's about coming to 4 years. Before that, I was just exploring myself.
Investing
on my own.
Okay.
And, trying to figure things out. And then,
Right.
okay, this is something which I want to do. Write a blog. I want to, I enjoy writing. I enjoy speaking to people. I enjoy investing as well. So I want to do something which I enjoy and put them into be it a blog or whatever you call it, where I can actually make use of the work which connects really to myself.
Right. So at what age do you buy your first stock?
So I bought my first stock in 2010. It was a tobacco company listed in the US.
How old were you back then?
So I'm 37 this year.
Okay.
That means minus
14 years ago.
Yeah, that's
23.
about 23. Yeah, so
While
23.
you were studying.
So I was still studying, and
Okay.
that was in my second year in university.
Okay.
Second or third year in university.
So going back to your uni years, you're from material engineering, and then after discovering what you like to do, you switch to like double down, because you technically cannot switch your degree, right? And then you were already halfway in. So I reckon that you were talking about like switching out your elective to finance modules. All the mentors that you were talking about, the books, I think they are in the realm of value investing, which is of course like buying the stock as if you are buying part of the business.
Yes.
And then you are like sort of like part of as a business owner, and you want to understand the business. Like young people, sometimes they will be in a dilemma situation, like especially during studying years, and then halfway maybe they realize that this might not be the right path for them, but at the same time they also fear switching. Right. So for example, like I had a friend back then in our JC years. He completed year 1 of JC, and then at the year 1 he was telling us that he feel that this is not the route for him, and then he dropped out and he switched to poly and restarted. And then back then we were like, we're all kids, and then we're like, wow, this guy is so courageous, And of course now he's the owner of a creative agency already.
Wow.
So he switched to like doing mass comm, and he has to restart year 1 in poly. To me, I mean, this is like a very courageous move. And for me, I only got that courage after like many years later when I exited the government job and then became a realtor back then in 17 years ago. I mean, what gave you the courage at that point in time? I mean, like, you didn't want to just pursue I believe back then engineering was a very hot favorite. You're probably a very stable career. So what gave you the courage to know that, okay, this is something that you really want to go all in on, double down on?
That's a very, very good question. I think first of all was I knew that. So for myself, right? So my personality is, if I like something, right, I will go all in on it. If I don't like, right, I would just throw it aside. Like I wouldn't even bother about it. And that's very dangerous. That's very risky, because if you are being brought up in a Singapore education system, you cannot do that. Because the moment you do that, you will sort of get failed from the system. And I almost failed that. And I didn't want to show my parents that, hey, your son is a university dropout. He got kicked out of school. Finance was actually that beacon of hope or light, which propels me forward. Like,
did they say anything like, why you don't want to go into engineering? Why will switch to finance? Or were they actually okay?
So they were actually quite supportive
Okay.
of what I wanted to do. And back then, I didn't really tell my parents specifically that I wanted to go into finance. I just tell them, say, I'm interested in investing. I'm interested in stocks. And the first thing they say, hey, very risky here. So, is it safe and all that? And I say, so I remember I mentioned to my mom, I say, this is something which I want to try to do and try to understand first. And I sort of shared with her what I've read, what I've discovered, the intelligent investor, that stocks are not supposed to be treated like pieces of paper, but as part ownership of a business.
Right.
So I explained to her what are some of the myths, what are some of the misconceptions. My mom has always been very supportive of what I do. So she just let me, do what I do. She said, if this is something which you want, you should just go all in for it. And that was something which made me think hard about the decisions which I make. And it's also because I didn't really want to disappoint her as a son, being the eldest son in a family. There's also that little responsibility of wanting to make sure that, I make her proud as a son, right? So this is something which I said, this is something which I want to do. If it doesn't work out, I'll just go back to engineering. And what gave me that drive, what gave me that push was finance was something which fulfills a lot of my own personal needs or personal values. Things like being curious about things, around me, being curious about learning new things. I'm someone who always like to learn something new. And if this knowledge really appeals to me, I will continue to sort of go down that rabbit hole. And of course, at the same time, it's also to make money. I mean, back then when we were in our 20s, who doesn't like the sound of making money? And also because of the whole background where my dad wasn't doing pretty well, that also sort of drove me to want to understand more about what this new field is like, which I've never really understood in detail. Because most of the time when I hear about people talking about stock investing, I always hear about them trading, about, trading in the market, about gambling and all that. So I decided to actually go in there and to really understand for myself, is this really the case? Is this really true? Is there a consistent way to invest and make money out of this new field which I've discovered? So the more I actually put in my time and effort into it, I realized it's something, I kind of enjoy doing it. And despite that, it's not my main degree, I didn't really bother. So my thinking was, okay, I will just try to get my C's and my D's, try to stay afloat for the 4 years. And I will sort of divert most of my time and energy into, okay, I want to understand about finance, I want to understand about investing in much greater detail here.
Right. So when you first discovered value investing and then learning about businesses, and of course holding it for the long term, which is I think probably the inspiration to come up with your dividend strategy, right? What if, let's say, for example, somebody wants to start young, but they don't have they have limited capital? I mean, usually what is your advice now at 37? If you look back to somebody, maybe the uni grads talking to you, they're in their 20s or they're still studying halfway. What is the best way or the fastest way to start to get into this? What kind of strategy can a young person use?
Okay, that's a very good question, Melvin, because I do, people have also asked me in their 20s, even early 30s as well. They'll ask me, hey, really, how to get started investing? And dividend investing, like what you have rightly pointed out, you need a slightly larger capital base. What I always suggest first, before you even get started investing, is to start reading up about the different strategies which which connects to you. Because not every strategy appeals to everyone and not every strategy works for everyone. Each strategy might actually appeal to certain personalities. You might be someone who might not enjoy long-term investing because you might not like to sit around waiting for things to happen. You might, do more trading, or your strategy might change where you might just focus on a more short-term time horizon in this case. So that's the first thing which I will ask myself. The second thing which I will ask myself is also, okay, if I want to get started investing, the next thing which I will do is set aside some money, a small amount of money, and try to figure out what are some of the psychological biases which I might have. You might read on books, you might talk to people and they will tell you, oh, investing is easy. Just put the money in. Next day you get, this amount of returns. Next month you get this amount of returns. But what matters most is actually the psychological management of an investor or someone who actually invests. What I mean by this is that you might put $1,000 today into the stock market, but how your emotions and how your psychology reacts to the stock market becomes very crucial. Because you might put in that money and you might think that, hey, don't worry, really, I can hold on to this, even if the market goes up or goes down, it doesn't matter to me. But in reality, when you put that money in, right, some people's relationship with money will change. And that would actually make them perhaps more anxious, could be more nervous. And that is actually a very small nuances or pickup point to sort of ask yourself, hey, what's going on with my emotions and how is my relationship to money, to stock investing is. And that would be a sort of a little window to understand, how we want to approach investing. So it's not say, okay, I follow this investor and he's making a lot of money, I want to follow his strategy, but it's more of trying to understand what sort of psyche or psychology which we have, what sort of emotions we have, how do we manage that, and how do we actually connect to the different strategies. At the end of the day, it's about our own personality, whether it fits to the strategy which we want. Because over the years, what I've also realized is that there are many, many different strategies, and all of them actually works. There's no right or wrong answer in investing strategy. It's just a matter of what kind of personality suits your strategy here. Right. And if you want to get started today, it might not be a dividend strategy. So this is something which is very contrary to what I'm doing, dividend investing. But it could be just buying a basket of stocks, which is an ETF or an index. So an index is basically buying, let's say, a list of 500 stocks on the US stock exchange, and you basically just track that over time. You just buy it for the long term. And if you see historically how this index have actually performed, they have performed on average about 9-10% over the last 30-40 years, which means you don't really have to do much here. And it's a good way to get your feet wet. And then after that, you can sort of think about, okay, what sort of strategy I want to try. So when I started out, I didn't go into dividend strategy straight away. I was trying all the different kind of strategies. So I was reading about Warren Buffett, for example. His strategy changed over the years. For mine as well. So I was dealing with things like what you call special situations. It's a strategy which a lot of the hedge fund managers like to use. So basically what you do is you go into the stock market, you're trying to find stocks or companies where they want to spin off certain business unit, for example. And when they spin off this business unit into a separate stock, the market might not like that stock. And they might just sell off their stock for some reason. Because if I'm the fund manager who owns company A, and tomorrow I get some shares in company B, which was spun off by company A, I might not like to hold that stock because I don't know what the company is. So I might start to sell down company B. Special situations means that you want to analyze company B and try to understand, hey, are the fund managers selling because they don't like it, or is it there's something wrong with the business? So one example could be years ago, we all know this company in Singapore called Singapore Telecommunications, Singtel. They spun off a company called Netlink Trust. And it wasn't because Netlink Trust was a very weak company. It was because back then, I think that was in 2017. Right. The company, the government basically said that, look, you cannot own Netlink Trust because that will be, you will be basically monopolizing the entire fiber optics market in Singapore. Don't forget, interest. Exactly. Right. Don't forget, you don't have just Singtel, but you also have M1, you have StarHub. And because of that, they were forced to sell down that particular company, and that company Netlink Trust had to go into an IPO. That also actually caused some selling pressure because back then, the institutional players, the big fishers, the fund managers, they have no idea what's going on. So that could be an opportunity, for example.
Right, to buy in.
So that was what you call a special situation strategy. So I was trying all sort of this strategy before moving into a dividend investing strategy.
Right. So would you be right to say that, I mean, somebody that's young, the very first season is actually to build your capital first. Some people might maybe in a spur of the moment, they might realize that, I want to become like a full-time investor or trader, but they don't have that first set of like basket of funds to invest in. And of course, you work for about 6-7 years in the corporate world, right? And that's of course how you build up your salary or your savings and all that. Like what is your advice to somebody that is like graduating? Like, I mean, like to be strategic as well, get into like the workforce and then like accumulate your funds through a salary and while you're investing on the side. Like how should they actually strategize this move?
Okay, so if they want to get started investing, there's actually two what I call engines of building an investment portfolio. One is you analyze stocks. One you analyze stocks and you invest. But before going to that, you need to have capital, which is what you mentioned. Yeah. And that will mean trying to build up your career capital, trying to improve your salary. Another one, which is very important, and that's a big underrated skill, I'll call it a skill because it can be taught, is to actually learn how to save. And it's a very simple concept, but people don't take it seriously. Right. Now, what do I mean by taking it seriously is when I was in school and when I was tracking my savings and my budget, what I did was, before all the apps, before all the technology started coming out, I was basically tracking all my budget on a spreadsheet.
Okay.
So I was tracking how much money do I want to spend every month, how much do I want to save, and how much, basically I will pay for transport. And I was counting down to the exact dollar. So say, for example, during the weekends, I'll tell myself, okay, I'm only going to spend $30 or $40 and that's it. If I cannot watch that movie, so be it. I will just skip that movie. And that was a very, very important thing for me because it's not easy to control, sometimes your urge to want to spend.
Your impulse spending.
Exactly.
Yeah.
So I basically did a budgeting of how much I want to save. When I graduated, or before I graduated, when I started working part-time, say for example, I worked during the school holidays as a cable technician, for example, and the pay was roughly about, I can't remember, $1,500 or $2,000. I told myself, after I received this check, I immediately set aside more than half of the amount into a separate account. And I'll track it, how much to save, and I'll keep doing that. So whether I was giving tuition, whether I was working part-time, or any form of income, if my mom, sometimes she gives me allowance on my ang pao money, I'll also just save it up and I will just track it down to the exact detail, which I find that not a lot of people do it. You can get easily lost into this whole thick and thin of finance. So tracking your budget, saving, I think is one crucial thing. Another thing is something which is very difficult to control, and that's something which I also personally experienced, is that kind of what you call that creeping lifestyle. Meaning that when in an environment where people talk about chasing the next car, the next Rolex, the next
Especially
watch.
when you started working, right? In the initial years, in the bank as well. Yeah.
Trying to upgrade to a private property when you're fresh out of school. It's very difficult to, it's easy to get sucked into all this when your colleagues are talking about it. So for myself, back then, my girlfriend and ourselves, we try to live as frugally as possible. So we stayed in a four-room HDB. We didn't buy our first car for a very long time. We just chose to take public transport. Weekends, we just go out for simple meals and movies. We enjoy cycling. We enjoy things where it doesn't cost much in Singapore, especially when it's so expensive, when things are actually quite expensive here in Singapore. We try to keep our costs low so that we can actually save as much as we can. So that's how the whole idea of savings, budgeting came about. But of course, I must say that everyone's background is different. So for my case, I was a bit in a more luxury or lucky position because I didn't really need to give money or allowances to my mom when I started working, or as long as I made money. So my parents were quite self-sufficient. They had their own savings, they had their own income. So that allowed me to accelerate more of my savings, exactly.
Right.
And that also allowed me to sort of save as much as possible while I was in my corporate career.
In accumulation, you had the savings from your schooling years, then you control a lifestyle. And at the same time, you build your savings from your career as well. So when you decided to resign and then during the COVID years, resign from a corporate job, private bank, I believe your income will have reached a certain level of comfort. Would you mind to share back then in terms of your portfolio, what gave you the confidence to come out? I believe that maybe by that time there's already a certain level of matured strategy. So maybe your portfolio is of a substantial size that grants you a dividend on an annual basis or quarterly basis. So what was that maturity that gave you the confidence to exit? And then now you're doing this full time. Of course, you're also in the space of giving content, education and all that, right? And you continue to invest on your portfolio and then you share your journey. So what was the maturity level that gave you the confidence?
So 2018, I think somewhere end of 2017, beginning of 2018, I was really rethinking whether I want to, continue working in corporate, after going through some of the...
After the burnout event.
Burnout event and all
How
that.
does that make you feel, by the way?
It was very tiring.
Were you married already?
So back then, I just got married. I completed my CFA program and I felt that...
And you were still in the bank?
So I was still in banking.
Okay.
But it also leaves me the question, okay, so what's next for me? So that burnout was also combined with the question of asking myself, okay, what's next to move on to?
That was early 30s.
Yeah, that was in my early 30s.
Okay. A bit of mid-career crisis also.
Exactly.
Okay.
So it was also a bit of a mid-career crisis. And I was asking myself, is this what I want to do for the rest of my life? Because number one, I felt that I wasn't suited for a corporate culture. Number two, for me, I've always enjoyed the idea of creative freedom.
Okay.
I like to share ideas. I like to talk about stuff. But in banking, sometimes it can get quite restrictive because of compliance reasons.
You cannot create content. I believe like you'll be in. I mean, like you are subjected to MES and all that.
Yeah, so
Correct.
you might get flagged down. If you do that, and there might be some conflict of interest as well. I felt it wasn't something which I wanted. And when I was speaking with my colleagues, who were 10, 20 years older than me, and I asked them, what they did and what they do and how they're feeling. And it got me thinking about, is this where I sort of want to move to what they're doing? I mean, it's nothing wrong with what they're doing. They have a family, weekends they spend their time driving their kids around. And what I did here or observe is that a lot of them, after a while, they sort of treated their career like just another job. And that wasn't something which I want. I mean, if you ask me, for me, work is really about fulfillment, and
they weren't enjoying.
Yeah.
Okay.
And at least for myself, if I didn't enjoy the work which I'm doing, it's very difficult to motivate myself to want to do it, and I will get demotivated very quickly, very easily. So I was in a place where I wasn't feeling motivated back then. So it was quite tough for me to want to continue. And that's where, that sort of pushed me out from that sort of like comfort zone.
So that was a push factor.
Yeah, that was a push factor.
Did the value of these stocks appreciated as well, like because they were doing well and because you picked the right companies?
So in the long term, it did. But of course, there were periods where the value actually fell. Things like during 2020, during COVID, for example,
Right.
it actually fell. Back then in 2018, it also fell as well. But if you look at, even though it's not a big figure or not a big amount, but it gave me the confidence to say, okay, this is something where I can afford to quit, do something, and try to work out to see what other directions which I want to actually move towards to.
Right. So why I asked that, I mean, like in terms of your total portfolio value, is that because value investing, based on what I understand, is like long term. As long as the companies are solid, there's a solid moat, there's like key USP, there's a lot of things that is like protecting the company in terms of the growth, the management and all that kind of stuff. When you hit seasons whereby there's like a downturn, right? Sometimes the downturn could be just for a short while, sometimes it could be a very long term. Do you sell those stocks, or like do you switch, or like you actually like go back in and then just analyze again and then you continue to hold it until you recover? Because the reason I ask is that as you hold for a long term, are also the dividends affected when the stocks come down and stuff like that? Like, how do you fathom that? Because just now you mentioned about the psychology of money. Some people, when they see the stocks come down, they want to exit, right? Or some people, they just overhold it for a prolonged period of time to a stock that has been mismanaged already. How do you analyze that, and then how do you make decisions?
That's a very, very good question here. So when we talk about market drawdowns, or when there's a sell-off in the market, so the whole idea of investing is you are trying to hold stocks as pieces of businesses where they have a durable economic moat, they have a sustainable competitive advantage, so that even when there's a crisis or when the economy is not doing well, the business still continues to grow. And if you look at crisis or certain market cycles, when there's a sell-off here, say for example, one case was during COVID. So that's where I saw my portfolio value drop. What I did was I revisited all the stocks or the businesses which I own. I try to understand what's going on. So it's a bit tricky here, because that's where, inevitably you will get sort of pulled into that fear.
Emotion.
Yeah, the emotions. Because 2020, no one knew exactly what happened. And for myself, for my mom's portfolio, for my own portfolio, it was also quite a scary time, because you don't know what's going on.
Everything is red.
Exactly.
Right.
And, talking about your relationship with money, your psychology with money, what I did was I tried to fall back on the whole fundamentals of what investing is. So at the end of the day, is this company, I always ask myself this question for every stock which I own. Will this business still be around, the next 15 to 20 years? Will customers or people still continue to use their products and services despite some of this crisis, be it COVID, be it the global financial crisis? So it can be very simple things like banking services. So Singapore banks, I'll ask myself, with COVID happening, would the banks shut off their business today? Would people take out their money straight away and hide them under, the mattress or in a biscuit tin? So I always ask myself that question there. And I try to reason that back with the financial data, the statements which I analyze to see, how have their business been affected by an economic crisis? And I ask myself, whether, can they actually recover from crisis? So how I look is I try to look at businesses where they've been around for, the last 10, 15, 20 years. So the longer the better. And I try to analyze, can they actually survive some of these market cycles? One case in point, like the Singapore banks, they have been around for many, many years. One of the hardest hit cycles was during the global financial crisis. All the banks suffered in terms of the operations, in terms of the businesses. But for Singapore banks, which I do own shares in them, they have actually survived, during the global financial crisis. They've even survived during the 1997 Asian financial crisis before some of these mergers happened. So this gave me confidence to want to continue holding on to some of these stocks, and also try to add more position or increase my
when the stock price is low.
Yeah, correct.
Right.
So that's how I sort of manage that. It's definitely not easy. There are times, of course, where I would sort of panic sell, but I always sort of tie back to the fundamentals. Is this something which driven by really just fear? Like, is that internal voice telling me, something is, everyone is scared, you should sell? Or is it something else where, I want to sit down objectively, I have a checklist and I take through, is the company's revenue doing well? Is the profits still doing well? Do they still have cash flow? Is the company borrowing a lot of money? Do they have enough cash in their balance sheet, in their bank account? So I ask myself some simple questions like this to sort of give me that confidence that, they will be able to pull through. Because if you look at past market cycles don't last very long. And, they tend to recover, after a couple of years. And if I'm able to actually have that tenacity or the discipline to hold on, there's a good chance where the market will recover and the business will actually do much better than it was before.
Right. So what will make you sell a stock?
So there's
like today,
so there are three big points which I will sell a stock.
Your own internal criteria.
So for myself, 3 reasons why I will sell a stock. The first one is if the business, the fundamentals starts to deteriorate. So all businesses, they all go through a certain life cycle, a certain life stage. And there are businesses where there are times where they will definitely not do well. There's new competition coming in, or there could be some oversight by the management. And if the fundamentals start to deteriorate, that means if I see on a periodic basis that the revenue starts to drop, the profit starts to drop, they're taking on more borrowings, they're borrowing more money, that's where I start to sell my stock. So I will cut my position, I'll cut my loss. At the end of the day, it's also trying to be objective that if things don't do well, I'll just sell it. So Peter Lynch did mention about this. Investing is a lot like trying to prune your garden. You are trying to water your flowers, but at the same time try to cut off the weeds which are growing in your garden. So that's something which I try to focus on as well when I try to sell a stock. Another reason why I will sell a stock is when there are better opportunities. So say, for example, I might own company A today, and maybe company B, when I chance upon company B, I realize that it's a much bigger company. The size is larger, they're paying, the dividends is growing. They have a much higher dividend yield. And based on their valuation, I find that it's more attractive than company A.
So you switch.
That's where I will sell company A for company B.
Right.
Reason why is because for a portfolio, we cannot hold all the stocks in the stock exchange or in the index. There's no point holding all. So typically you will hold a basket of stocks, and you want to treat each position as a very precious position because it's an opportunity cost. If you buy a stock today,
you can't buy the other one.
You can't buy the
your money
other
is stuck
one.
in this one.
Exactly.
Right.
So what I did, if let's say if there's a better opportunity, I'll sell the one where there's less opportunity and move on to the what you call the higher opportunity or the better opportunity.
Right, you hunt for the better value one. Right.
The last reason is really because of human error. That means I might get too overconfident about myself, about the company. That means I might get too attracted by what the CEO or by what the management says. As an analyst, where I talk to a lot of company management over the years, I wouldn't say that I'm experienced in reading people, but sometimes company management can be very good persuasive speakers. And they can tell a very good story. And that could actually throw you off track as an analyst. So sometimes they tell you a good story, but you wouldn't know until when the results start to come out, the results doesn't show, and you realize that, hey, something is not right here. What the management says, what the CEO or the founder says doesn't gel with the results. One example could be one of the companies which I used to invest in is an apparel company, and the company management says that, we are going to reorganize the business. The creatives are not doing well, but we are going to hire new people, and it's going to recover in a very short period of time. So I got attracted to the story which the management has said.
The charisma also.
The charisma. And every quarter when I read about the company,
it doesn't
doing the profit margins is not improving. Employees are leaving the business. So it dawned on me that, hey, there's probably something wrong going on, not
within
right.
The company.
Yeah, within the company itself.
Yeah.
So and because of that, I took it objectively as a human error, and I sold off the stock.
Just now I asked you about when would you sell a stock, right? So the next question is, when would you buy a stock? So allow me to give you two scenarios. If you see a stock A that is like a growth stock, but no dividend, then B stock is like, it's not a growth stock. Maybe in relation to property aspect will be like, this property is something that appreciates or has a very good chance of appreciation, but rental is very low. Then the other one is like low quantum, you can enter, you can get this condo, but rental is very high. But you know that the growth is very tepid, or it will be stagnant because maybe the lease is not as strong, right? So maybe like it's getting old already, balance 70 over years old and something like that. But rental demand is extremely strong. And because you're getting a low quantum, your rental is high. Yeah. So A stock and B stock, one is a growth stock that you're quite confident it can build your portfolio strength. And then B is like, it pays good dividend year after year. But A don't pay dividend. What will you buy at? And what would you advise? I mean, like now you have a sizable portfolio. Would you do that? Then if somebody is starting new, would you advise them to do A or B?
Okay. What I will say is I will try to classify into 3 different categories here. So I'll try to open up this question here. So one is growth, no dividends. One, there's growth but very little dividends, but the dividends actually grow pretty fast. So we assume that the dividends grow fast. And the last one is like what you mentioned about properties, very low price, but the dividend yield is very high. Now, for someone who wants to get started investing or dividend investing, what I always suggest is somewhere in between. That means a company where there's a good growth potential, plus is starting to already pay dividends. I probably wouldn't go for a company which has very strong growth and no dividends, or a company where there is very cheap in price, the share price is cheap, but very high dividend yield. And the reason why is because of the capital size. For stocks where they have a high dividend yield, and typically your capital doesn't really grow too much, it's more suitable for investors where they have a larger capital base. That means they don't really want to see too much capital growth. They feel that they don't want to take on that risk.
They want stability.
Exactly. And they need the income. So the high yield naturally is suitable for them. So in this case, if you are a young investor...
It's more like a retirement portfolio.
Exactly.
Right.
So it's something which I'm also building for my mom as well. Like we sort of transited her from more of a dividend growth to a higher yielding portfolio.
Lower volatility.
Exactly.
Okay.
And more diversified.
Right.
Where I will focus on is companies where they have growth, and also pay a lower dividend yield, but the dividends grow. Now, why don't I choose the one where there's high growth but no dividends? Is because a lot of times these companies, it's very difficult to understand whether they have, like what you mentioned, an economic moat. A company might grow very fast, but they might not be making money. they might still be making losses. And growth does not mean that they may have a competitive advantage. So they might grow fast because early adopters or early customers
There's a lot of hype.
are interested in that. But if you look at companies over the years, when the growth starts to slow down, and if the operating cost of the business starts to catch up, typically the losses will increase year after year. And there are many, many companies like this, especially during the 2022 market crash, where a lot of the, what you call the tech stocks,
Right.
high growth companies don't pay dividends, not making money. They all crash, 60 to 80%. And this is something which I try to avoid.
Right.
They don't really have that durable advantage. And I wouldn't want to go in there to look at these businesses because I don't really understand, because these businesses, they might change, the businesses, the industry which they are in changes very fast. The landscape changes very fast. So I have no way of understanding it. Whereas for companies where they have healthy growth and they're starting to pay growing dividends, the misconception is that people might think that, hey, this is a mature company and it's slowing down. But that's not true, because if you look at companies like Facebook, which is under Meta Platforms, they recently started paying dividends. And they are also considered a mature company, but they are also growing. So this is where I want to start looking or start fishing out my ideas. And the reason why is because if you look at these companies where they start to pay dividends, right, it's usually a sign of strength, financial strength. A company management, when they decide to pay out dividends to their shareholders, actually requires a lot of approvals, a lot of thinking, because when a company pays dividends, they cannot conveniently take away that dividends. They cannot say, okay, this year I will pay my shareholders dividends. Next year I choose not to pay dividends. It will actually cause a
drop in confidence.
Yeah, drop in confidence in the market.
Right.
So when a company decides to pay dividends, they sort of know that, okay, I have some track record. I'm making some sustainable profits. Now this is where I want to start paying my dividends. So in this case, I start to narrow my criteria for looking at businesses. When I look for these companies, immediately I'm already screening out companies which have a much longer term track record. They have some form of reputation. There's some form of size.
And starting to pay dividends.
Exactly. And they have, what's more important, predictable profits.
Right.
So that means I know that the last 5 to 10 years, they are making X amount of dollars. I know in the foreseeable future, they will probably continue to make this kind of profits over the next 10, 15 years. And these businesses, typically the industry which they're in doesn't change too much. So you know that, for example, like food businesses, food companies, F&B companies, consumer companies, you know that maybe the next 15 years, people will continue to drink, let's say Coca-Cola, or continue to eat McDonald's. And things don't change much, right? It won't be disrupted by technology. At the end of the day, people like fizzy drinks, they like sweet drinks. And this is something which I tend to focus on. I wouldn't wake up today and say that, hey, I don't want to drink Coca-Cola because of new technology which is coming out, or there's new research showing that research is trying to depress the desire for sweet stuff. It doesn't work that way. Again, things like consumers' preference for cheap things. We always like cheap budget. We want something cheap. No one will go out there and say, hey, I want to buy things which are more expensive. So it doesn't make sense there. That's why big companies like Amazon, they focus on this kind of consumer behavior. You are focusing more on what people want and things which doesn't change for the next 15, for the next 20 years. And when you're looking for these businesses, focus on these businesses where they're focused on this kind of trying to understand customer behavior this way.
Right. So like where or how do you hunt for this kind of businesses that is in the middle? Like the ones that you're recommending to look at. I mean, like growing, stable business, but starting to pay dividends. And where do you do your research?
So I will give two different points of view. So one, if you're starting out, and one, if let's say if you're sort of mid-journey into your investing journey. When you're first starting out, what I would suggest is to look through a screening criteria. That means you can go on any financial websites. Let's say if you are investing in Singapore stocks, I will go onto the SGX website. They have a screening tool for you to tick the checkbox. Okay, I want this company of a certain size, how much money they're making, some financial indicators. So that requires some form of understanding of what financial ratios are. That allows you to narrow the number of companies listed in the stock exchange to just a small handful. And that's where you can start looking for the ideas. So you might be looking for companies where they might not have very high dividend yield, but you will notice that over the last 5-10 years, they have been growing these dividends very consistently. So that's one way which I would start it's one way where I'll get started as a beginner investor. As I sort of progress in my journey, what I'll share is I'll start reading up newspapers for ideas. So not necessarily get distracted by the media, but trying to understand what are some of the businesses out there. So trying to understand the headlines for these businesses, what's going on. So I'll get sources from newspapers.
You Google them.
Yeah,
right?
correct. Google them. Talk to friends. So building a network of like-minded investors. A couple of years back in 2012 or 2013, I remembered me and two other friends, we actually started this investing group. And what we did was every month, we will sit along the benches of SMU University at City Hall, and we will just talk about ideas. We will share one idea every month.
You just sit and talk there.
Yeah. So three of us, we will just sit and share what ideas we have actually come across for that month itself.
Okay.
Why is it good? Why is it bad?
Do you
What's the
attract a
risk?
crowd?
So we didn't, because it was just a discussion, like,
Okay.
just any other normal students. But what was interesting was we also started to attract like our friends. Like we say, hey, we got this group going. Are you interested?
Then they'll come there and join.
Yeah, and it sort of grew over time. Like every month we just sit there, and it turned from just a regular chit-chat session over a bench to a classroom setting.
Oh.
And into
How many
like
people are there now?
it's not very big. It's roughly about 50 plus.
Wow.
So there are people who come and go.
It really became a club.
Yeah, so it's like a small club of fund managers, private investors, analysts, people who are just generally interested in investing, and we just share ideas, but only on the topic of fundamental value investing.
Value investing, okay.
Exactly.
So, back to a question for like some people who are keen in investing, right? Is that you mentioned about these three groups of companies. One is like growth, no dividend. Second one is like good companies starting to pay increasing amount of dividends. Why do companies want to pay dividend? Maybe you can explain like this in a simple format.
Yeah, that's a very, very good question. The reason why companies want to pay dividends, number one is they want to actually show confidence to their investors. So at some point, they will say, okay, I want to reward investors. I want to reward my shareholders. Thereby, I want to pay dividends, and also a sign of confidence to the stock market, to the financial market, that say, hey, I've achieved that level of success, that level of status. Because if you look at businesses, right, a lot of times when we look at stocks, we look at it from a bird's eye point of view, but we don't actually think about what the managers are thinking in terms of the day-to-day operations. And for managers, when they're able to pay dividends, it's actually a sign of stability and showing that, hey, I can take care of my team, my employees, I can take care of my shareholders. It's a sign of
the fruits of labor.
Exactly.
Right.
So this is one reason why they pay dividends, to show that confidence. Another reason is also because it's also one form of rewarding their shareholders. You can pay dividends, or there's another way is also to buy back your shares in a company. So if you buy back, you can make use of the company to buy back shares to increase that value. But in Asia, a lot of Asian companies, a lot of Asian founders, what they like is, they like their red packet, they like their Hong Bao, and Hong Bao comes in the form of dividends. So in this case, that's also one of the reasons why they pay dividends to investors or to shareholders.
Coming back to the part about dividends, right? Is that do you think that with dividends and also with compounding, can it grow to like when is the point that you can enjoy this? Like because at the start, if you look at the compounding graph, at the start it's usually the accumulation phase, right? And then there will hit a point whereby the amount of like interest that you accumulate actually supersedes your original capital. What is the discipline for this approach? And will you ever like draw down on your portfolio? Because by drawing down, it will affect your dividend that you draw on an annual basis, right? So what is your plan as well? Like, and what is your method of discipline?
For a dividend portfolio, there's actually two ways to look at it. Or in general, for investing in a retirement portfolio, there's two different schools of thoughts. One is a withdrawal portfolio where you invest to a certain amount, and then after that, you start to take down a certain percentage, maybe 3% or 4%. So they call it the withdrawal rule.
So they sell down.
So they sell down
to
gradually
enjoy it.
To enjoy it. So that's one way of doing it. Another way is you accumulate your capital to a certain point and also growing that dividend yield at the same time, such that the income which you receive is enough to fund or finance the expenses which you want or which you desire for the rest of your life without touching the capital. So there's no right or wrong here. The withdrawal method, people like it is because they feel that, if you can you can increase, if you can generate, let's say 10% a year, you draw down 4%, you still have about 6% to grow that portfolio.
Right.
But psychologically, it can be a lack of a better word is challenging. In Asia, we generally don't like to sell things. We like to buy and keep
accumulate
stuff. It's a lot like, I guess, properties, right?
Yeah.
You want to hold on, pass on to the next generation. So the idea of trying to sell down your portfolio might seem very simple to understand, but in practice, it gets very tricky to sell down because it's quite painful.
Is it because of like a anxiety factor?
Could be because the thinking is, okay, if I sell down today, what if I suddenly need money for health reasons or emergency? Then I might miscalculate the amount of money which I need to take out from the portfolio. So that becomes a risk which people might not be able to foresee. So that's one method, the pros and the cons. The other method where, the traditional dividend yield method is you just collect the dividends without touching the capital. So for me is, I tend to focus, if you ask me, I prefer to use the method where I can collect the dividends without touching the capital. Primarily because I don't really like the idea of sort of drawing the capital down over time. A couple of reasons. There will still be market crisis. There might still be market cycles, and there will be time where if your portfolio is situated during a down cycle where there's a sell-off in the market, it gets very painful to continue to sell off part of your portfolio to pay for your expenses. So it's a lot about trying to deal with your behavioral biases, more so than trying to understand the mathematics behind both methods. I would say that I think it's a lot about trying to get comfortable with who we are as an investor, our own personality, what we feel more comfortable with. So for me, I tend to be more what I call risk averse. I don't really like to draw down my capital unnecessarily. So I like to sort of accumulate it and then try to improve the dividend yield over time. That means, starting at a low dividend yield today of say 2 to 3%, but over the next 10, 15 years, this yield will continue to grow from 3%, 4%, 5% as the company increase or grows its dividends over time.
So you let it like fully replace your lifestyle income?
Yes.
Okay. So like, for our so-called like maybe listeners who are like planning for retirement. Now you're at 37. I believe like even in real estate investing, we call it like the very aggressive age that you can start to accumulate, invest, take a bit of risk. Then I usually will advise my clients that by the time you're 55, because there's various factors involved like minimum sum and all that kind of stuff, right? Then you start to go into a more defensive stage and then your kids are growing up and stuff. Because some people, they can maybe go into a extreme old age, but because of like accumulation, it has been so many years, they're still very fearful to enjoy their fruits. Yeah, like maybe they've been accumulating all their life until 65, but they still don't want to take a bit of their fruits of their labor to enjoy life, right? Like, or to do the things that they want and stuff like that. So how do you balance out? Or what's your advice for retirees?
Yeah, there's a very good book which I read. It's called Die with Zero. I think it was by a hedge fund manager. Okay. And he talks about this thing which I agree with him called memory dividends. So instead of collecting dividends as income, you try to collect dividends from your memories. That means you try to create memories from it. So what I would think about, how I would sort of rethink this whole approach is that while I accumulate this amount of money, but at the same time, I also want to think about how can I create memories for myself over the years. So memories can be as simple as bringing my kids for a short trip. For example, like we are going to Japan this June in Hokkaido and, to do all the self-driving and all that. That's one way to actually think about it. If you need
to draw down a bit, you draw down a bit.
Then I will draw down a bit.
Right.
Exactly. So trying to think about...
To use it to buy memories.
Yeah.
Right.
Because if your jar of dividends is filled, I think the next thing is a lot about fulfillment, about trying to think about, okay, what can I do to enjoy my life in terms of the fulfillment, in terms of the values which I resonate with. So in this case, then I will try to balance out with that jar rather than just trying to hoard the amount of money.
So Dove with Zero is like, how do you balance your investing, and then you draw it down to invest in memories until it hits zero by the time you die? Is it like that?
So it's something like this, but you don't have to take on this is a very extreme approach.
Right.
But you can sort of take one step at a time, thinking about, okay, maybe this year I might take out some money to think about how can I create a meaningful memory for, let's say, if you have grandkids or for my kids. How can I use this amount of money to enjoy these things which money can never buy? Like it can be just simple experiences. One good example, it could be just say buying bicycles, and we can just cycle around Singapore. That could be one thing which we could enjoy, and something where money can't really buy.
Do you believe in like leaving money for your kids next time? Okay, I read the book by Peter Buffett, which is Warren Buffett's son. He's into like music and stuff like that, and he says that his dad has already told them that a huge percentage will go to foundation, and then he will only leave them like an amount to bless them to kickstart in something. Yeah, so it's like for him, he got a lump sum kickstarted in his music journey, but he knows that he will not get everything, right? So, and I think Warren Buffett, like, he lives a simple life. He still like drive to McDonald's, drink Coke and all that kind of stuff. So like, what about yourself? Like, do you believe in living everything for your kids or a certain amount to bless them? Because like we all know that if by the time you retire or you pass on, like 80 plus or something, your portfolio is so substantial. Sometimes by living everything, that it will cripple them. Yeah, in terms of their will to fight and their will to create things and things like that. So what was your thought process like?
Actually, it's a very good question, Melvin.
Yeah.
To be honest, I haven't really thought about this deeply in detail because there's a lot of different school of thoughts. But if that time happens, like let's say if I'm in my 80s and we are about to pass, if let's say if I passed on and the money goes to my kids, I think a lot of the fighting spirit or the hunger, my own personal take, is not really driven by the money you have, because I realize that there are people who are born rich but might not have that motivation or that hunger. There are also people who are born rich but they do have that intrinsic drive or motivation. So I think it really depends on how my kids grow up to be. If I observe that, hey, both of my sons, one is 6 years old, one is 4 years old, over the years, if I see that they have that natural drive, that natural competing factor to want to succeed and get better in life, there's no reason why I wouldn't pass the money on. If I see that, hey, they are not doing anything, they are lazy bums and, they're not doing much, then I might want to be more careful with how I allocate my money.
So it really depends on your observation of their maturity level.
Yeah. And, wheels can be, your estate, your wheels can be changed over time. And let's see, based on my observation, how they have sort of grown up as, individuals.
Right.
Today. So that will be one of my driving factors. So it's not so much driven about how much money I've accumulated or whether or a hard and fast rule whether I want to give them or not. But it's more of like who are they growing up as a person, as an individual. Then I will actually determine, okay, do I really want to do this for them? Because if let's say if they are someone who can motivate themselves, they want to do better in life, then there's no reason why I shouldn't pass them the money and do something good with that money. Because at the end of the day, it's also how we do our relationship with money, how we actually connect to this whole fuzzy thing about, this whole fuzzy thing about money and its value.
Yeah.
Right?
Yeah, I totally agree. I think it's not also really about like whether are you born from an average family or poor family or a rich family, because in both sides of the coin, there will still be two different behaviors.
Exactly.
Yeah, some people are born average or from a poorer background, but they have a strong will to fight. But some will still choose to give up. Yeah, and then some people are born rich, they will have a strong will to fight to prove that they don't have to depend on their parents' wealth, right? But some would choose probably to really spend everything, right? So I think it's really about the dual coin approach within each spectrum. I want to go to the next topic, is that I want to ask you, do you or have you, or did you ever, or currently now, have you invested in cryptocurrency? What are your thoughts?
So for myself, I'll have to put a straight answer. I don't invest in cryptocurrency. And the reason why is, okay, I know it's going to send a lot of haters, so please don't cancel me. I don't believe in cryptocurrency. I do believe in the technology behind cryptocurrency.
Blockchain.
Right. Even though I do not know as much as what the experts or insiders think or they know, but I do know that, it's something which will be beneficial. Cryptocurrency is a bit different. Cryptocurrency sort of abuses the fact that, that they tell people or tell investors or the market in general. So I might not know too much about this. This kind of cryptocurrency has a certain value. So that's what is sort of being implied today. But it's very difficult to try to figure out what that value is. So they are trying to say that, cryptocurrency can be that sort of the next replacement to, say, our fiat currency. There are a lot of factors behind what makes currency stable. There must be some form of fundamental value driving currencies in terms of the economy, in terms of the value, in terms of the output. Cryptocurrency is different. Cryptocurrency, at the end of the day, I will just quote what Warren Buffett said. And, I was, 2 weeks ago, I was in Omaha to attend his Berkshire AGM.
Wow, okay.
And he said something about how artificial intelligence is a lot like releasing the genie out of the bottle. And it's a lot like, how nuclear wars are started. I would think that cryptocurrencies is a lot like what artificial intelligence is, where the genie is sort of being let out of the bottle. It's a lot like how people first discovered nuclear war. It's hard to actually keep that back in. But that also means that people can actually easily abuse cryptocurrency. I mean, if we see back in 2022, when interest rates spiked, a lot of the cryptocurrencies and the alternatives to cryptocurrencies actually fell close to zero and they all were wiped out. And it really shows one thing, that this whole alternative asset class is still in a very infant stage. No one knows exactly what's going to happen in the future. I mean, it could take many years, it could take decades, or 50, 100 years to allow this kind of cryptocurrency to stabilize. But at this point, at least for myself, it's very difficult to try to pinpoint any fundamental reasons driving cryptocurrencies.
Right. How about properties? Do you invest in properties?
I would love to invest in properties. Actually, my wife and myself, we were actually looking around, and that's why we were watching a lot of your PLB videos. Right. Properties, one thing which is interesting. So I don't. We want to actually invest in physical properties.
Own home.
We own our own home.
Right.
Of course, to own, with government cooling measures, is actually very difficult to actually own a second piece. So what I did is I try to buy REITs, for example, which owns a diversified group of basket of different properties.
Right.
And reason why is because you actually see some form of stability in the business
without managing it.
Correct.
Yeah.
The asset class has some form of stability. You're looking at rental income. You are able to actually observe. So one case in point, for example, it might not be residential, but it could be commercial or retail. It's easy to get down to, say, one of the Heartland malls or in the Orchard Belt area.
And all that.
Yeah, you can see, whether they're doing well, you observe them, and you can actually tie it back to the numbers, the financial statements. And one thing I really enjoy about properties is it gives that kind of stability to the portfolio. You know that, the next quarter, if the company the REIT is doing well, or the property company is doing well, you will more or less receive a certain amount of rental income or a certain amount of dividends. So that kind of stability, that kind of consistency allows you to also project, what sort of expenses or what sort of income I would get for the next 12 months, for the next 18 months. And then, I can better plan out my expenses. Investing, one thing which I've also realized along the way is that it's not about, trying to maximize your profits or the returns. You're not trying to gain like the highest returns in a shorter amount of time. What you're really trying to go for is the consistency. That means at the end of this year in 2024, will I still get the same amount of dividends as it was last year in 2023? Because that's very important. When I want to project my expenses, I wanted to think about where I want to bring my kids for holiday the next year. I want to know how much I'll be making this year or next year. And one of the very few asset classes or the few sectors which give that kind of stability is actually properties.
Right. So in your own definition, what makes a good dividend portfolio? Is it like, let's say for example, a family, husband and wife, maybe they calculated per month they need like $8,000, family expenses, car, mortgage, and then kids' tuition and stuff like that. Some living expenses. Let's say it's $8,000. Then you multiply by 12, which is 96,000. What in your definition is a good portfolio in terms of dividend play? Like, does it mean that if every year the dividend they receive from the portfolio is 96,000, do you give it like an A rating? Like how do you define it? Like in your own terms.
Okay. So the dividend portfolio will be split into two different parts here. The one which you describe is the amount of returns or the financial objective which I want. So what I will do is I'll try to reverse engineer how much income will I want to get out from this portfolio realistically. And realistically, why? Is because, writing my blog for a couple of years now, I have people telling me, hey, really, I want to get $96,000 a year.
To cover everything.
To cover everything. Right. And I ask them, how much capital do you have now? And how much would you like to achieve? How long would you like to achieve? And sometimes they tell me, in a couple of years. And I will sort of press the calculator for them and I say, do you think you're able to achieve 30-40% a year in order to make this kind of income? And usually they will just shake their head, because that would actually force you to go into very risky assets or risky investments. Instead, what I will do is I'll try to think about realistically, how much can I actually make from a dividend portfolio? So this is based on, looking at some of the past returns that investors have made, by talking to people, talking to other dividend investors, how much returns generally they're making, and try to figure out,
returns in terms of dividends,
right, or the total returns. So the dividend income plus the capital gains.
Oh, okay.
So both, and I try to figure out, how much returns can you actually make from a dividend portfolio?
So capital gains, you take it as a performance indicator as well.
Yes.
But you will need to sell down to enjoy the gain.
Okay. So you don't have to sell now, but say for example, if I have a $200,000 portfolio today, and if I grow it to, let's say, $400,000 or even $500,000, it doesn't mean that I have to sell down. What I could do is, when I hit the $500,000 mark, I could start to switch out for stocks where they actually yield much higher. Because I have a much higher capital base now, I can also invest in stocks where they are also yielding at a much higher dividend rate because of my larger capital size. So I can actually do that instead of sort of draw it down. So that's one way to actually think about it. To think about first the financial returns I want. So always mapping out a blueprint for the next 15, 20 years, taking into consideration my family expenses. So it might not be able to cover most of the expenses, but why a dividend portfolio helps is it helps to ease some of the expenses or the cost. Like the client which you just mentioned, using the dividend portfolio to pay for his mortgage. He might not be using his dividend portfolio to pay for his entire family expenses, but he could use it to finance his mortgages, for example. It could actually meet the whole purpose of having that dividend portfolio. And that's also one very crucial point which a lot of people, and what you have mentioned, a very good point, which people tend to actually overlook. Because a dividend portfolio doesn't mean you have to cover expenses. It could mean covering a certain portion. It could mean
paying for your car,
right, traveling, buying that nice bicycle, for example, or that Harley Davidson which you have always wanted. So it could be that.
In your recommendation, how do a retail investor have sort of like a set and forget kind of strategy? Maybe looking at it once a month rather than like going every day, become very anxious and all that. And what will be some, maybe like 3 tips that you can give for a retail investor? Okay, for example, minimally dividend must be how many %? And how do they know that, okay, this is going to be a company that is stable, growing, has a good moat? Like, is there like 3 tips for investors?
Okay. First,
with a retail investor in mind that don't want to spend too much time to look at it every day, maybe like once a month. Yeah.
I think first I really like the part where you say that whole idea of, just buy and then you just forget about it. But you also need to sort of check in every month to make sure that everything is intact. So I think that's what's important for investors. You don't want to just, your idea of set and forget means that you don't need to look at it every day like what you said, but to look at it also on a money basis to sort of monitor it. So that's, I think, one very crucial point. Now, the 3 tips here is what I do suggest is, it really depends on the strategy which you have. So if you are looking at, for dividend portfolio, there's 2 main strategies here. One is you're looking at lower dividend yield, higher growth. That's a dividend growth strategy. Or you can look at lower growth or almost zero growth, but higher dividend yield. And that's more of like a retirement kind of portfolio. So it depends on which camp you are in. And deciding on which camp you're in ultimately decides on what sort of stocks you want to pick. So what I will go for firstly is to look at whether the business is still intact. That means the fundamentals. At the end of the day,
it is still a strong business.
It is still a strong business or not. So what I want to look at is whether they're making money in terms of their revenue, their profits, whether they have free cash flow. That means the amount of money which they collect more than covers the amount of money which they use to pay to maintain the business. So I want to actually look for signs of that. The second thing, of course, it must pay dividends. Otherwise, it can't be a logical choice to the portfolio. So it must be paying dividends because that is showing a sign of financial strength. A company which pays dividends, typically they are much larger in size. The management has gone through a long thought process on deciding whether to pay dividends, whether to allocate that capital. So it's actually very important. It means that management has already gone through a very stringent process of deciding whether how much money to actually pay in terms of capital, how much they have actually leave aside to invest into the business. So the company must pay the dividends. And the third one, which is very crucial, and I think a lot of people also tend to overlook, is don't take on too much leverage. So not take on too much debt, not just for the portfolio, but also for the individual companies. So you want to be looking at businesses where they tend to be more self-reliant, they're more self-sufficient. There are cases where you might come off with a lot of companies where what you call are dividend traps, means that they trade at a very high dividend yield, very attractive. But if you look at the fundamentals, the financials, they have a lot of debt. Yeah, they have a lot of debt. Their business is not doing well. And sometimes they might be borrowing money in order to finance the dividends because their profits might not be making money. And in order to maintain the dividend payout, maybe to the shareholders, maybe to the founders themselves, in order not to shake the confidence of the stock market,
they borrow money,
and they'll pay the dividends. So I will actually pay attention to that. So the 3 points here is making sure that the business fundamentals are still intact, making sure that the profits are still sustainable, they're still growing, making sure that they are paying dividends, and of course, don't take on too much leverage.
Right. Okay. The 3 tips. Okay. Do you buy insurance?
Yes, I do.
Okay. Do you? Because now, as a dividend strategy person, right? So do you buy like insurance that are investment linked? And do you believe in it?
I used to believe in it.
Okay.
When I started out, investment link, I think they call it whole life insurance or investment link products, where they either invest into a basket of securities or you can get to pick your unit trust. I used to invest in that, but to be honest, I actually divest most of it.
Do you switch to term insurance?
I switched to term insurance, and reason why is
yourself.
Yeah, I'm quite a low cost kind of guy. So I like the most bang for your buck kind of strategy. And term insurance in all the products, I think so far is the more bang for your buck kind of strategy. So you buy and you forget. My ex-boss, who used to actually work in an insurer, she mentioned, for insurance, just buy term and invest the rest yourself. So that really hit me hard. And I'm thinking, simple concept, but if you think about it, term insurance is, it's one of the most budget insurance out there. Cover yourself for a certain amount of period and take the money which you could save. You can just invest it yourself elsewhere. So this is what I would do for insurance.
Right. Okay. Awesome. Final question is what maybe just final 1 to 2 questions. Let me think. What are 2 to 3 books that you recommend people to read if they are going into investing or dividend investing, or maybe just as a young investor? What are 2 or 3 books that you think in this era will help to shape them, or maybe will really add value to them?
It's a bit difficult for me because I got a lot of books which I want to share.
Okay.
3 books. The first one definitely is The Intelligent Investor. I know it's a bit dry. It's a bit difficult for a lot of people starting out to invest, to read it. It requires some form of basic finance terms and knowledge. But I recommend to try to read, even you don't understand, just read it first and read again. Because those information which happens in The Intelligent Investor will sort of stick in your head after a while. And when you start to go more deeply into investing, those ideas will actually start to pop up and make more sense after that. So Intelligent Investor is the most basic foundation, which I will get started. The second one, which I really enjoyed, so this is something which is non-investing related, is a poetry book by Khalil Gibran. It's called The Prophet, and I really like it because one of my mentors actually recommended me this book. He's a Lebanese poet, and he writes a lot about describing very simple concepts and terms like family, what's love, even marriage. And he describes it in such fine details where the words really sort of, jumps out at you. And what resonated with me is that it really made me understand about emotions, about my feelings, about my emotions. What am I sort of attracted to? What sort of words am I attracted to? What sort of feelings I do get? Many times when we invest, it's also the same way. When we look at certain companies, when we read certain articles, look at certain ideas, certain things will jump out to us. And I think it's important to actually try to connect with that. Trying to, punch through data after data sometimes might not work too well. After a while, you might get burnt out, which was what I did. Trying to understand, trying to read about things outside of investing also helps a lot. And I get this way of learning different fields from reading The Intelligent Investor, Benjamin Graham, because he wasn't just a mentor to Warren Buffett. He wasn't just an investor or a businessman. He was actually also a literature teacher. And he excelled in different fields, and that made him who he was as an investor, because he was able to take different ideas and try to connect those dots, try to cross-pollinate different fields into the idea in investing. And I thought that was something interesting. And trying to understand, reading about poems, for example, is totally different from investing, and that's what I really want. So that's the second book by Khalil Gibran, The Prophet. The last one is it's a book written about Charlie Munger, who passed on late last year. Charlie Munger is the vice president and also the partner and best friend of Warren Buffett. And Peter Bevlin dedicated this entire book called Seeking Wisdom. And basically it's a collection on what Charlie Munger says about human psychology. At the end of the day, investing, again, is not just about your financial data, hard numbers. It's about understanding consumer behavior. It's about understanding your psyche, your psychology. Why is it that certain people buy certain stuff? Why is it that people keep going to buy the same products or services over and over again? One example which I got, one of the big lessons which I got when I flew to Omaha to attend Warren Buffett's AGM, and
it was the first time without Charlie Munger.
Yeah, it was the first time. So you could still feel that sense of loss for Buffett. What really took me away, one of the big lessons was when he mentioned about Apple. Like, why was Apple one of his biggest stake in Berkshire Hathaway? Was because he was giving two different examples of buying an iPhone and a car. So a lot of people wouldn't hesitate to take out their money to buy a car or an iPhone. But if you ask them, which of this would you buy? Like, would you buy a second iPhone or would you buy a second car? He says that most people wouldn't hesitate to buy a second iPhone as compared to a car the second time. And it was very interesting. It was very profound for me because it really got me thinking about the idea of consumer behavior and psychology. And when you think about businesses, at the end of the day, essentially it's about what customers want, what people are buying, what they're hungry for. And Warren Buffett says he doesn't know anything about the iPhone technology. He doesn't know what's the latest chip inside. But what he understands is consumer behavior. And he understands why is it that people buy iPhone. I mean, I personally own an iPhone. I wear an Apple Watch. And it's so difficult for me, like if today I lost my iPhone, I will probably cry more than if I lost my wallet. And there's also one little nuanced behavior of consumer psychology. And this is, again, trying to understand what makes customers tick. And that is also one window to move into trying to understand about investing, about businesses, about companies. So it's not just about understanding shares which are traded on stock exchange, but it's understanding what goes behind the businesses. How do these businesses go deep into trying to understand the customers themselves? And this is something which Charlie Munger have said over and over again. And that book called Seeking Wisdom has packed a lot of the different psychological biases, behaviors, all inside there. So I would highly, highly recommend anyone who wants to pick up investing to also read that book.
Right. Awesome. Thank you. One last question. So just a recap on 3 books. One is The Intelligent Investor, The Prophet, as well as Seeking Wisdom. One last question is that what is your end goal? What is your purpose? What is your purpose in life?
Wow. Very heavy question. Very hard to answer.
Yeah.
I'm 37 years old. It's very difficult. It's something which I've been trying to ask myself over and over again, each day. Something which I want to ask myself to do. For me, it's really trying to connect with what has meaning to myself. Like what connects to, for the lack of good word, is what connects to my heart. What makes me feel, what resonates with me when I do something? Does it bring me joy? Does it bring me fulfillment? So simple things like trying to read on my blog, invest, looking for great ideas, insights. That really jumps up at me. So that's something which I try to connect the dot and try to follow where sort of brings me that kind of satisfaction. I might not like it on certain days. I might wake up saying, okay, I don't want to write. I don't want to read another Warren Buffett quote. I don't want to look at another stock for the day. But that could just be temporary. But if it really connects to you, right? Like a craftsman, you will just continue to do it. And you'll do it because you know that it resonates deeply with you. And this is something which I try to work towards too. I won't say I have the full answer, but at least it's like one step closer to that.
Right. Awesome. Thank you so much. Thanks for coming for our NOTG podcast. I think it's really a pleasure to have you, and of course to share about all your thoughts and all that. We have one final one. Sorry, I missed out this candle card. Okay, usually we will play this before we end. Yeah, just pick one card and then we ask you final question. And just pick any cards that you want. Yeah,
I'll pick blue.
Okay, great. Come read out your question.
Question.
Yeah.
You have an opportunity to choose any role in your current company. Which position would you choose and why?
Okay, right.
Okay, so I guess my company is myself alone. But if you take it from a more general point of view, if you ask me, that role will be someone more of an educator, someone who I would say inspires or want to teach, share the knowledge or the insights which I have with someone else. So for me, I enjoy connecting with people. I like to, sit down, have a cup of coffee and talk about what's the latest ideas going on. And I see myself as that role in, whichever company. If let's say if I have to work in a corporate today, that is the role which I want to focus on and build my strength on. I think it's something which I kind of enjoy. And for that very brief moment in private banking and in banking, I actually enjoyed that role because as an analyst, I also have the luxury of following the bankers, the relationship managers to client meetings, to talk about their portfolio, to talk about what's the latest potential ideas, what's going on in the market. So that's something which I kind of enjoy, and that's the role which I would probably take on.
Right. Awesome. Okay. Thanks for sharing all your insights, and I really appreciate because I personally learned a lot through these 2 hours of just asking you all the questions about dividend investing and stocks and value investing. And I think what I got out of these 2 hours is that you are not just like an investor. You sort of like also look at your journey, understanding about your life, your purpose, and then meaning of like investing, psychology of like anxiety, our relationship with money, and also like I sort of feel that you have like a deep interest in understanding about how things work, how businesses work. And through your journey, I think you also like sort of take a bet on yourself, like to try courageous things, to break out certain norms and all that. So I just want to thank you for coming in to inspire our audience, and also to share your insights so generously. And just want to thank you for that. Thank you so much.
Thank you so much, Melvin.
Thanks.
It's been a pleasure.
Yeah. By the way, over the weekend I passed by a bookstore and I was just thinking like, although you
wow.
Yeah, I don't know whether it's a new book or not, but I think this will be very good for you and your business. Yeah.
Thank you so much, Melvin. Wow.
Great. Okay.
Shall we have a photo?
Yeah, sure. Okay. Yeah, let's take a photo. Thank you. All right.
Thank you so much.
Okay, come. What time do you have to leave? Is there any time I need to take note of?
No, it's 3 to 6, right? So I was given the time slot 3 to 6.
Okay,
So,
so you're quite chill lah.
yeah, I'm quite chill lah.
Okay.